Welcome back. You're still tuned into Midcap Masala right here on ET Now. And as promised, let's put the spotlight on the luxury cars market then. And to discuss that in greater detail, we are now joined by Sanjay Thakker, Chairperson and Executive Director at Landmark Cars, who is now joining us here in our Mumbai studios. Mr. Thakker, morning. Thank you so much for coming all the way to our studios. And you've reported strong numbers for FY26. About 20% top-line growth is what you've reported. And I was just going through your presentation. Your outlook for FY27 is also very positive. What makes you this confident?
So what has happened is that in the last 18 months, we have added a lot of capacity. And that capacity, I'm very proud of our team that we executed to the T. We set up all the outlets in time within the budget, and our operating teams set them running, up and running, well within the stipulated targets that we had. So this is now the year where we will reap the benefits of all the expansion that we have done. And what kind of expansions did we do? We added nearly 22% of the company in 1 year. What had taken us 25 years to build, we added 1/4 of that nearly in 1 year. And the good part is that we added capacities mainly for EVs. We expanded with Mahindra and Mahindra, with BYD, with MG, and nearly 21% of what we do today is EVs. So it's a good place to be sitting now.
Right, and after-sales service is also one of the other factors which aided your top-line growth, and it crossed that 1,000 crore mark in FY26. What is the kind of growth that you're seeing in this market, and as a percentage of total revenue, how much is it now and how much could it increase by? I'm asking this question because it is a more margin accretive business, right?
Yeah, that's actually 1,000 crores. Now, that's a number that has taken some time to sink in for us also. And it's a 40% gross, nearly 18% EBITDA margin business. And it's been growing for the last 10 years at 14-15% compounding. So that's something that we have got that growth back. We have a very solid base now to build on. And that's something which we believe will continue to deliver year on year.
And since it is more margin accretive as compared to the normal sales that you do, will it aid margins? Because margins have been in that 6 to 7% mark for the last few quarters, but this time around it came in at 5%. What will the growth outlook be for EBITDA margins?
I think what is important to note, Shesha, is that we reported our highest ever EBITDA, highest ever gross profit for this quarter and the year. And the margins have been inching up as our outlets become more and more mature.
Correct.
So this is something which is a journey. It's a very predictable business that we are in. And it's very easy to track what we will do. And the good part is that more and more people are buying cars. You see the auto growth numbers even right now. And we believe that with the GST cut which has happened in October, a new kind of growth trajectory has come into our life.
Can you quantify that growth trajectory in numbers for us? What kind of profitability? I believe you reported about 38 crores of profit in FY26. What will the EBITDA margin and revenue and profit target be for FY27 and beyond?
It's, I think, difficult to put a number to it out here. But what I can say is that for the newer outlets, we had burnt around 40 crore rupees in front loading of expenses. Now that is something that we don't expect to happen. In fact, the new branches and the new brands will start delivering positively to the profitability. We are already seeing those numbers happening. So clearly much better times are ahead of us.
And two main growth drivers. One is electric vehicles and other is also operational efficiencies that you're working on. What are the kind of efficiencies that you're working on?
So what really happens is that when you start a dealership, your workshops are not really full. That takes a little bit of time to fill up.
Correct.
Now the good part is that those workshops have started to fill up or already full. We have announced that for, say, Mahindra and Mahindra, we have added one more workshop in very short time in Hyderabad region. So once that happens, then as you rightly said, the higher margin business, which is the after sales, that contribution increases in the total mix. So that is something which is happening. At Landmark, we are also sharing our manpower wherever we can, some other resources. So this is something which actually helps the margin growth over a period of time.
And let's also talk about demand then. We talked to a lot of experts on air, and some of them were suggesting slight slowdown in luxury market because of West Asia. I understand that there is no direct impact, but sentimentally, is that hurting demand?
So far, not, fortunately. So we are seeing strong order intakes right now. The concern in our mind not always, in the last 2-3 months has been whether the supplies would kind of be consistent and seamless. For some time, the demand has been strong, and as we speak, the demand even now continues to be strong. So there has been no letdown in demand.
Okay, so no impact so far. And you have already tied up with a couple of makers. We have Mercedes and a couple of other BYD. You spoke about M&M as well. Any other in the offering, anything that could be added?
Right now we have our plate full. We have enough and more that we can do. And this is the year where we have to deliver. This is the year where we have to consolidate and get back to our original matrices that we are so used to.
And what about store expansion plans then? You were telling me that you are already present in about 13 cities. Are you looking to expand further?
We are present in 13 states and nearly 30 cities out of that. And we represent 11 brands, 1 in 6 Mercedes-Benz or 1 in 5 BYD sold is by Landmark. So we have growth for the last 27 years has been the way of life for us. And this is something that will continue. We will not get into a very rapid expansion that we did 2 years back for specific reasons.
Right.
But now this a kind of a normal growth, which will be better than the industry, is something that we will continue to do for many years to come.
Clearly good times ahead, but debt is also another factor, and you've paid down your debt substantially over this year largely. What is the debt profile currently, and how much do you aim to get it down further?
So the good part about this business is that it generates cash.
Correct. It is not debt heavy, basically.
No, and for Landmark, we haven't ever taken long-term debt to expand. Everything that, and I was telling you that we started with 1 store in 1998. So everything that we have done so far is by way of internal accruals. So that has led to this place that we are in. So the debt continues to be paid down as the cash generation happens. We had an operating cash flow of nearly 270 crores last year, a cash profit of nearly 100 crores. And that is something that goes into reducing the debt, working capital debt, that is.
Correct. And how many days of inventory are you sitting at?
So the industry normally believes that around 30 days or lower is a healthy thing. For the last entire year, or maybe more, we had been kind of holding our inventories much lower than the industry. What we have done consciously in the last week of March is to kind of stock up, which is maybe 4 or 5 days more than what we would have normally done, for the reason that there has been a price hike. The prices of all cars have gone up, or most cars, from April and some even from June. So we will get a one-time benefit of getting that profit in. But inventory days are really pretty much in control for us. We will bring them down once the supply situation is some concern about that is behind us.
Correct. Let's also talk about individual brands. And first, BYD. I believe there were some import concerns and there were some restrictions. Has it completely normalized?
So there has been an issue of homologation. We all know that BYD is the #1 new energy vehicle company in the world. And in India, the product acceptance is excellent. The homologation of 3 of the models have already happened, and the supplies have started quite well right now, and it's trending well.
And what is the revenue or the commission sharing model that you have for Mercedes? I believe it is different as compared to other players.
Yeah, it's a very interesting and a customer-centric business model that has been introduced. It's what, 3.5 years now, maybe 4, where the customer experience at the showroom level is similar, except that there is utmost transparency. There is no price haggling. All India is one price. The dealers do not carry the inventory in their books. The customer directly pays to the factory. He gets a choice of all India stock, which he can choose from. So that has worked really well. It has taken debt off our book, inventory of our book, and the customer experience, as I am saying, is really much, much better.
So win-win for everyone, for
Absolutely.
dealers, for Mercedes, and for the customers
yes.
at large. We also discussed about how input costs have risen for OEMs. Have they cut commissions on account of, or is that a direct benefit? Higher sale price means higher commission for you?
Higher sale price normally means higher commission. So far we haven't seen any thing that has impacted us adversely. Not only the new car sales, but also the spare parts prices. When they go up, we make a little more in what we would have normally made.
Okay, Mr. Thakker, thank you so much for taking your time out and joining us. And that was a very candid conversation. We spoke on a whole host of issues. And we're looking forward to hosting you once again as the year progresses.
Thanks a lot.
Thank you so much for joining us here in the studio.